Hi. When we think about valuation, we can usually think about some kind of discounted cash flow model or maybe some other, type of a trading-based model. But another very common, in fact, probably more common way that people actually value assets is to go out and do something called relative valuation. Relative valuation is when you try to find another apple and find the value of that apple and compare it back to the apple you already have to do a apples to apples comparison. And you say if one apple is worth $1, then the other apple, if it's pretty similar, should also be worth $1. That's the basic idea. If you want to go a little bit deeper into relative valuation, this is a good place to be. Stick around and we'll talk about it. A common way to value a company is to use a multiples approach. It is based on the law of one price from economics, which says that identical goods must sell for identical prices. Otherwise, people will buy the cheaper goods and resell them to the customers of the more expensive option, creating an arbitrage opportunity. While identical is nice in theory, in the real world we're going to apply this approach to similar assets. We can use ratios such as price to earnings or PE ratio to compare the values of two similar companies. This method only works when comparing companies that are as similar as possible. We could probably use this method for GM and Ford, but we certainly couldn't use it for comparing Walmart and Amazon because they just aren't similar enough. The PE ratio is simply the selling price per share of a company's common stock divided by its earnings per share. We could also divide the firm's market capitalization by its net income to get the same ratio, since market cap is just the number of shares times the share price, and net income is just the shares times the earnings per share. This ratio represents the price today of $1 in earnings for the company in question. Some companies expect a lot of growth in their future, and $1 today is expected to grow into many more dollars in the future. While other companies may be mature or even contracting, and today's $1 worth of income might not grow to be much more than $1 in the future. Well, which would you pay more for? Of course, you'd pay more for the company that is expected to grow more in the future. Many people would agree with you, and they would buy up those shares. The stagnant stock would trade at a lower level, while the growth stock rose in price because of the supply and demand imbalance in the two shares. However, if we compare two companies that are very similar, especially in terms of forecasted future growth or profitability, we can expect the price of $1 in earnings to be close across the two firms. As such, we can take a company's expected earnings per share in the future and multiply it by whatever you feel is the appropriate price to earnings ratio and get the value of the firm at that point in time. So, where can we get a good estimate of the right price to earnings ratio? Well, we start by looking at the competition and trying to pick some companies that might give us an indication as to the prospects of this company's stock multiples. We can also consider the company's own historical price earnings numbers as long as things haven't changed significantly for the company in question. Imagine company A trades at 15 times earnings, and I'm trying to value company B, which is very similar to company A. If I know company B's expected income for the year in question, I can multiply it by company A's price to earnings ratio after adjusting the multiple for some firm specific factors and get a decent idea of the value of company B. What happens though if either firm has negative earnings? Well, that would make the PE ratio negative and render it useless. In that case, we might consider using the price to sales ratio or price to book ratio as multiples that might be useful to help us estimate the value of the firm in question. Multiples analysis has many uses at the firm, industry, and even macroeconomy levels. It especially comes in handy when doing discounted cash flow valuation and you find yourself in need of a terminal value. But we'll explore that more when we discuss discounted cash flow valuation in the future.